So AJ, start off and telling us a little bit about yourself. I know you have your MBA from Rotman, right?
That's right.
That's a
So
decent one. It's not as good as Western.
no, it's not as good as Western, but it nevertheless is good enough for me, I think. No.
and
uh,
and you work in no, you go ahead and take it away because actually why I wanted to have you on the show is based a lot of us have read Rich Dad Poor Dad. I'd actually be curious how many people who listen to this haven't read it. So if you haven't, join the rest of us and go and read Rich Dad Poor Dad by Robert Kiyosaki. But he talks about uh, you know three things everyone should do. I think it's how he went about it. Anyways, he said start a business or buy a business
right,
or invest in real estate, something like that, right?
right.
So you're in the business of trading businesses. Is that right?
That's right.
Okay.
That's right. So, yeah, you're right, Urban. I work for a brokerage that only specializes in buying and selling businesses. We
Mm-hmm.
help owners of businesses sell their business and prospective buyers buy one.
Mm-hmm.
That's essentially what we do, and that's the niche space that we operate in. A bit of a background about me. I did my MBA from Rotman, graduated in 2009, probably one of the toughest times to graduate. Taught me a lot. Did my CA from India, worked there for a few years, moved here to do my MBA. Um, Post MBA, worked with the CIBC for a couple of years. Spent some time in mergers and acquisitions, investment banking, like that gig. So started doing. Took a role to do mergers and acquisitions for an insurance company.
Interesting.
Yeah, and at the time, the insurance company that I started working for were doing a lot of acquisitions, anywhere between 3 to 5 in a year, which
Right.
is a lot for a company to do because
Right.
it takes a lot of time and effort and resources to even evaluate a transaction, even on close a transaction. We used to close 3 to 5, which means we used to look at probably 7 to 10 a year
Right. Right. Oh,
to
sorry,
be able.
AJ. Just to slow down for listeners who aren't as familiar with this lingo. I went to a
Sure,
good business school, so I understand what you're talking about.
sure.
I jest. But so mergers and acquisitions. So let's take it back when you started for CIBC. What is the role of someone who works in mergers and acquisitions? What is your job?
So in CIBC, when I was working for the investment banking group, I spent about 6 months in that group. As an investment banker, you're advising clients on ones who want to either buy or sell their company. Advise them on the entire transaction. You advise them on the value. You advise them on the price to put in your bid. So very similar to what a realtor would do in a real estate transaction. You
Right. Right.
advise them on the transaction from start to finish,
Right.
and then you see the transaction through close. Again, very similar to what a realtor would do.
Right.
So to make it simple, just think of it as a real estate transaction, except it's a business you're buying. So there's a lot more in-depth analysis and due diligence you do. But the role of your advisor is fairly similar. Again, given the complexity of buying or selling a business, the advisor would have to be a little bit more sophisticated in terms of how you value different businesses, how you compare to previous transactions. Again, the foundations, the basic is still the same. It's just a little bit more complex. That's all.
And then what kind of dollar figure are we talking about? Like a million,
Um,
five
I've done
million,
I've done
20?
transactions ranging from in my career from 500,000 to 500,000,000. Yeah,
Just like
yeah.
real estate. And the risks are the same, right? Between a business and real estate.
Yes. Fairly similar. Although I haven't seen that many. Or they probably would be, but few and far in between, like multi-$100 million transactions.
Hmm.
It's a lot more common to find them in the business space because sometimes you're advising small businesses, sometimes you're advising mid-sized, and sometimes you're advising large corporates.
Hmm.
So it depends. For example, I don't know if you guys track, but Walmart recently bought a Indian online retailer called Flipkart for $16 billion. So that would be a mergers and acquisitions transaction. That would Walmart would have hired M&A advisors, and Flipkart, on the other hand, would
Right.
also have hired M&A advisors to advise each of them through the transaction.
Right. So maybe it's not a good example, but let's just stay with your example of Walmart buying Flipkart. So they would just go to a bank and then the bank would give them 80% loan to value and they pay like 3% interest rate.
No, it's so financing in a business transaction can be very, very different from, and this is where I think financing the transactions start diverging from each other. real estate is a hard asset. You can get a lot more financing, as you can see, maybe up to 95% in some cases, on real estate. Businesses not necessarily always have a hard asset. Like someone like an online retailer, what is really your hard asset? There is no vehicles, there is no real estate, there isn't a hard tangible asset to fall back on. All you have is your online platform and the fact that subscribers go on that platform to buy and sell stuff. So it's a fairly intangible asset, and it's hard to value that, leave alone finance that. So a lot of times you probably wouldn't get a whole lot of financing on those kind of transactions. Again, that's just a case in point. There would be other transactions, like you're buying, say, a car rental company. You have cars that you have as assets to fall back on. So you could get 50, 60% financing on that one, and you would still have to end up putting 40, 50% of your own money. So it really varies from transaction to transaction on how much financing you could get. And again, similar to buying real estate, it depends on your personal credit as well. How good is your credit? So similarly, how good is the business credit? How long has the business been in existence for? And for its life, how well or not has it performed? Has it been fairly stable? Has it been growing? Has it been declining? All those factors go into a bank making decision on whether they want to finance the transaction or not. Incidentally, I've also worked on the lending side for a bank. I used to lend to small and medium businesses, not for mergers and acquisitions, but just for their working capital and expansion needs. So I kind of know from that perspective as well what banks look at. They invariably almost always look to have some form of security or the other should things fall aside. So sometimes the business may not have enough assets. Then they would expect the buyer to give their personal guarantee along with personal assets to be securitized or mortgaged to fall back on a security for the bank. So you can get creative with the kind of financing deals you can do with a business transaction.
Interesting. So what I want to get to is I hear, and I'm sure you hear it too, people say investing in real estate is risky. So I think you're next. I think you qualify as an expert in this area because you are a real estate investor.
Yeah.
And then I say to people, okay, so, and then a lot of people can't really answer this question, but the question is, what is the cost of financing all these different businesses or assets, right? What is the cost to, so like most people on this call understand, it's pretty cheap to get financing on buying a house. Right? Even if it's rental property. Right. And then everything pretty much goes up from there. Like you buy a car, you buy a business, everything progressively gets much more expensive.
It does. Right? It does. So you're right, Erwin. Investing in real estate is risky, but investing in a business, especially if you're buying one, is riskier in my view. Right. And not just my view. I mean, you look at interest rates. When you go to borrow money for your business, your interest rates are way higher than what you would get if you were buying a house. You don't get business loans at 2% and 3% and even 4%. You're probably looking at, for small to medium businesses, you're probably looking at starting at, in the current market rate environment, you're probably starting off at 6-7%, and that too for like really prime business customers. It goes up to 8, 10, 12, 15%, even through banks, and then you start going to non-bank lenders. That could easily creep up to upwards of 15 to 20, 25% even. So that itself tells you that not just people like me or you, but even financial institutions and lenders consider businesses more risky than investing in real estate.
So I don't know if you can answer this. So again, for the listeners' benefit, Ajay doesn't have his questions in advance. So you mentioned online business. So say I am online entrepreneur. I want to sell product on Amazon and sell it online, and I go to the bank and ask them for a loan. What could I get?
If you're starting off, you're likely probably not going to get anything.
Nothing.
That's the hard truth.
What? Not 80% loan to value? I'll put down 20%. Just give me the 80%. Just give me the 80. I'll put down 20. Give me 3%.
Put yourself. Let's flip the table for a moment. Think you're the lender. Okay, I'm coming you to tell you, hey, Erwin, I'm starting this online gig, whatever. I'm going to sell whatever online. I'm going to sell mouse and keyboards online. Can you give me $80,000? I'm putting in $20,000 of my own money. And you're going to ask me, okay, Ajay, sure. What happens if you don't make money? How are you going to repay me back? I don't know. I'm sure I'll make money, so don't worry about that.
Hmm.
How are you going to react to that as a lender?
Right. And I
So,
only say this because a lot of people haven't gone through this process before. They don't
right.
understand. I think a lot of people don't have context for different levels of risk. Yes, it's
No,
risky. Yes, there's things can go bad in real estate, especially when you don't know what you're doing. Especially when you you know you, you buy like a house in a city in Ontario I've never heard of. That's usually when things start going bad. When I have to say I haven't heard of that place before, right? And when things go to bad, when things go bad, like what did you expect? It was a city of like 400 people.
I absolutely, Irvin, I couldn't agree more with you. Like, fully, there is risk involved with investing in real estate. So you need to be smart on where you're investing and how you're structuring yourself in terms of the transaction. Like, for example, what I generally look at, and this is what I've done with my investments
Hmm.
in real estate, is I put down 20%. And then I look at, and this is again one strategy. Irvin, you can talk more about other strategies, and you've done them yourself, so you know better. But this is one strategy, and probably I would say, feel free to give your opinion on that, Irvin. But I would say relatively lower in terms of risk profile is, you let's say you put down 20%, you do the math with the mortgage and with the rent that you're going to receive, and as long as your rent can more than cover
Hmm.
your cost of ownership and your property taxes and your mortgage and all the, like the entire cost of ownership including mortgage, as long as your positive cash flow, I generally am pretty okay investing in those kind of properties, because here's the thing: someday things will go bad.
Hmm.
Like, things are never going to be good all the time. But when they do, at least you know that you're not putting in money from your pocket to own that property. That property services itself in terms of its entire cost of ownership. That's the simple math I do. So as long as that's the case and you're not putting in anything more once you have it up and running, um, I think it's a good investment.
Hmm.
The second part that you need to look at is, the location that you're buying it in, the city, as you said, the demographic, what's happening there, what's the future prospect of that place. So you combine those two, I don't think you can go wrong with a real estate investment, even
Hmm.
if markets turn, and at
Hmm.
some day they will turn.
Hmm.
You have to think about holding longer term, not 2, 3, 4 years and flip it, 10, 15 years, 20 years. Your mortgage is significantly paid off in that time frame. Your rent is paying off the most of your mortgage during that period. And then you also have capital appreciation on top. So even if there's a downturn in 5 or 7 years, you have enough time to recover back from the downturn, because at some point prices will start going up. Look at the population explosion for our planet by 2030 or 2050, I can't remember. Actually, by 2030, the population is supposed to go up to 8 billion and probably 9.5 by 2050. We are at 7 point something today. All these people need space to live on. And you know what? There's only one thing that's of limited supply: land. Everything else probably can be manufactured. You can figure out something else. But till now, with the technology we have, land is still of limited supply. You cannot manufacture more of
Hmm.
land.
Hmm.
So from that macro view, you come down, look at Canada, look at the immigrants coming in, and where do immigrants like to go? Mostly in and around GTA. That's the most popular place for immigrants to come and settle down, just in terms of job prospects, just in terms of good living standards and whatnot. So you combine all of those pieces of information, and then you make a decision, and then you say, okay, if GTA, if I invest somewhere and overall math makes sense and returns make sense, then generally you wouldn't go wrong with those kind of investments.
Right, right, right. And I know recently you hired a property manager. And so where I want to go to next is around businesses, like businesses that you're looking to acquire, even for yourself. What kind of returns? Like, what are you looking for in a business that you're looking to acquire? And add to it that it's something I want you to suggest that's passive, as in someone you can hire someone so that you're not, you know, the same effort you would put into your investment property.
Right, right.
Go ahead.
Sure. So generally, what I look at in businesses is fairly similar to what I've been so far deploying in terms of my real estate strategy, which is cash flows. Right.
Hmm.
End of the day, whether you're putting your own money entirely or you're taking a loan on that, you need to ensure that you're able to find you're able to service the financing you've taken on, or you're able to get a healthy return for your money from this business.
Hmm.
So cash flow is very, very critical here. You need to go back and see probably last 3 years, 4 years, how the business has performed, what has the owner taken home in terms of after paying off all expenses and paying off everything else, what's left for the owner. That's important. We call that seller's discretionary earnings, or SDE, in sort of our world of buying and selling businesses. Another metric that you would look at is EBITDA. It stands for earnings before interest, tax, depreciation, and amortization. It's a good quasi proxy for cash flows, because your depreciation is a non-cash expense. Interest can vary based on how much loan or not you take. So the idea is that a business should not get impacted by the financing structures. You might prefer to put in all of your money, so you have no interest. I might take 50% loan, so I might have an interest component there. So you ideally want to nullify the impact of interest, and that's why you look at earnings before interest, before depreciation, and before taxes. Taxes are something that we all live with, and that should not change. It impacts your business decisions, but you have to look at a pre-tax basis to get a clear view or comparison between one investment versus the other.
Generally, the whole point was you're trying to compare apples to apples, at least numbers wise.
Exactly. One good metric to look at is payback period. What does a payback period tell you? Mm-hmm. It tells you how quickly can you recover the money that you invested in buying the business. So, for example, let's say you bought a business which cost you $100,000. Forget whether it's your own money or you financed it. Leave that aside. It cost you $100,000 and it makes $50,000 a year in profits after paying off all expenses before paying yourself. So in year one you get 50,000. In year two you get another 50,000, assuming it continues. So you've recovered your 100,000 that you paid for it in 2 years. So that's the payback period. Mm-hmm. If you can find something with 2 year payback, it's phenomenal. Generally, you wouldn't find something at that kind of a payback. But
that's funny because we use a similar payback when we decide renovations.
Yes, we do. Again, the kind of analysis you would do is fairly similar. Like you're trying to answer the same question. It may be a bit more sophisticated or complicated because it's a business and you have a few other variables involved there. But what you're trying to get at is how soon can I recover my money? Right. As simple as that. What does my money earn in terms of return on investment?
And just a quick example for the listeners' benefit, just to bring it back to real estate, is I don't want to spend too much time in real estate because I want to extract as much value out of you for buying businesses. But sure. Just for the listeners' benefit, an example would be like a dishwasher. Very, very common upgrade for people put into kitchens, especially apartment buildings.
Yeah.
You put in a dishwasher, you can often charge more rent because people love them. And so say you get $20 more a month, that means you can get in
$240 a year extra.
Yeah, $240 extra. So over 2 years, you can probably pay for that dishwasher. Yeah. So that's a good investment.
Exactly. And just to continue on that line of thought, Erwin, your dishwasher doesn't go bad in 2 years. It's probably going to last you for 10 years. So the remaining 8 years, you've already recovered what you invested on it, and the rest is all profit. Mm-hmm. So it's a good investment in my view.
Yeah. It probably brings down your vacancy too, so we didn't even include that.
And it makes your property more marketable as well. So that's an intangible benefit that it's hard to place a value on, but there is a benefit. We know that. Mm-hmm. So that's exactly the kind of thinking you would have in analyzing or assessing a business as well. Payback is one criteria. You have another one called IRR, internal rate of return. Essentially, what that tells you, there's a function in Excel that one can use once you're familiar with how to build, a cash flow model in Excel. But essentially, what IRR tells you is what is your money returning you based on the cash flows and what you've paid for it. Very simple example would be, let's say if you're paying $100,000 for something, and you recover 100,000 in the first year, i.e. your first year profit is 100,000, your IRR will be 100%. Mm-hmm, mm-hmm. Because you're recovering everything in the first year. So it changes as your payback extends further. So in many ways, IRR is a converse of payback. The longer your payback period, the lower your IRR. Mm-hmm. The shorter your payback period, the higher your IRR. Mm-hmm. So that's another metric that you would look at. And then once you have IRR for project A and you have IRR for project B, in this case business A and business B and business C, mm-hmm. you can compare which one gives you the better return and go for that one. Mm-hmm. Another common metric or way of analyzing a business is net present value. You would have heard this many people say this, a dollar today is worth a lot more than a dollar 1 year from now, right? That's because of the
That's why I buy
interest
real estate.
component. Yeah, in any realm of business or real estate or whatever, a dollar today is worth a lot more than a dollar
Yeah,
tomorrow,
yeah.
and that's
And
essentially because.
sorry, just
Sorry,
quickly for the listeners' benefit, this is the whole point of inflation, right?
exactly.
That's why I buy
Inflation,
real estate. We were defending against inflation.
inflation plus interest rate, opportunity cost, whatnot, right? So if you're putting in 100,000 out today to buy a business and you get $50,000 tomorrow, next year, or a year from now, and then another 50,000 another year from now, because that's what the business makes, you've recovered your money in 2 years. But what is your NPV? Your NPV, or net present value, is not simply 100,000 that you already recovered and the 100,000 that you put today. That's zero.
Mm-hmm.
But your business then keeps earning you even after that, right? So the assumption is, if the business keeps going on, generally you would make an assumption saying it goes on forever. Then you have to discount the value of those future cash flows
Right.
to today's value,
Right.
and then compare. And the net of that is your net present value. So as long as your net present value is positive, i.e., you get back more than what you've paid, then it's a good project to look at.
Right.
If it's negative NPV, stay away from it by all means. And again, NPV can be used across different businesses or across different projects to analyze. Business A might give you 100,000 NPV, business B might give you 200,000 NPV, and business C might give you $500,000 NPV, all for the same investment. They could have the same investment profile,
Right.
but they could have different earnings potential and therefore different NPVs.
Right. Would you ever compare? So you said it's cash flow though, right? So even if it's like a small cash flow investment property, say just cash flows $100, would you ever compare the two? Should I put my money into real estate or put my money into a business?
You would. The complication that arises here is you also have to factor in at the end of, let's say, whatever, choose, in this case, just to make the comparison easier, choose a 10-year or 20-year time frame and say, at the end of 20 years, what will my business fetch me if I sell this? What will my real estate fetch me if I sell that 20 years out? And then discount that to today's value, and then you get the full NPV of both of these. This is where you use net present value, because it's hard to compare my real estate giving me $100 per month versus my business giving me $2,000 per month. It's hard to compare that on the face of it. But when you do net present value on both of these, you'll know which one gives you a higher net present value.
Right.
And then you can look at, should I invest in this or should I invest in that? Net present value, just to simplify it, is what's the net wealth addition to my net worth. That's how you look at it, just to simplify it a little bit more.
Right. It's interesting because I always hear so many people are trying to get into real estate for cash flow. But no one's. Just my who the people who I speak to or who are attracted to talking to me. But not enough people are saying I want to buy a business so I can get more cash flow.
You wouldn't believe it. I live in a 2-bedroom condo. I have a 1-year-old daughter. I bought this 5 years ago, and when we started planning for a family and whatnot, we thought we'll need a bigger space. And now even more so, she's a year old, and we definitely need a bigger space. But I've been holding off buying a bigger space because I think investing in a business probably is far more cash flowing for me at this point in time than buying a house. If I buy a house, yes, I get the bigger space. It's good for my family, whatnot. But my money that I've put into my house, I live in Toronto, so obviously you're looking at nothing less than $1 million for a detached home in Toronto. The money that I put down, let's assume I put down 20%, $200,000 that I put down, it's not earning me a return every year. Yes, when I sell the house 15, 20 years from now, I get a big chunk, but along those 20 years, it hasn't given me any cash flows. On the other side, let's assume I find a good business which makes $150,000 a year, and I have to spend, say, even $500,000 of my money to get that. In 5 years' time, in 3 years' time, I've recovered my entire investment. And beyond that, I'm making another $150,000 every year extra on top. How does that sound versus putting it against a house for $1 million and not getting anything in return? Now, don't get me wrong. Yeah, don't get me wrong. If you're investing in real estate and renting it out, then you're getting a return there. So that's different, right? This is a bigger house for yourself. That's the kind of thinking I have in my mind is,
Yeah.
let me hold off on buying the house for a little bit
Yeah.
more. If I can find the right business which has cash flows, then I can probably get an even bigger house in 5 years' time than I can now.
Just get a bigger house and Airbnb some rooms. I know a good agent.
True. You can you can do that. Yeah, that'll give you cash flows for sure.
Now, this is an interesting question. You hear a lot about people saying, especially on social media, which whatever, people saying, build a business in your passion, and then you'll never work another day in your life. I've heard some of the businesses that you've been looking into. Are you passionate about those businesses?
I'm passionate about making money. How does that sound?
Yeah, so you never work another day in your life because you're making money.
Exactly, precisely that. Listen, some people are passionate about certain ideas, about certain issues, and you should absolutely pursue those passions.
Mhm.
But that does not mean that if you don't have, or if you don't feel very strongly or passionately about something,
Mhm.
you cannot do a business.
Mhm.
That corollary is incorrect.
Right.
You can absolutely do any kind of business you want to. You just need to. One, when I look at a business, you tend to first look at the industry itself. Is it something that I can wrap my head around?
Yeah. Oh,
I am.
yeah.
Yeah,
Well, I like this conversation we had before. Yeah.
yeah,
Sorry. Continue.
sure. I am, a finance professional by training, by education. Most of my work experience has been predominantly in finance. The last few years I've spent in operations, so I know a bit of that too. But I don't know science, or I don't know technology. Like I'm not the innovator kind. It's not like I'm going to suddenly come up with something, earth-shatteringly new that's going to be a massive draw to investors and becomes suddenly a big thing. Like, I'm not the Elon Musk that invented electric
Build an
cars.
electric plane. No, you're going to build an electric plane.
No,
An all-electric
I'm not
plane.
that person. The kind of businesses I've looked at is I've looked at a food franchise. You know why? Because I think I can wrap my head around how a restaurant works. You need to be smart about certain things. You need to be able to go in and see, what are the variables that drive that business. Essentially, in a food business, there are four big costs that drive that business. One is the food cost itself. Second is the lease or rental payments. Third is your labor cost. And fourth is, if it's a franchise, fourth is the royalty or advertising fee you pay to the franchisor. You can wrap your head around these four costs. If these four costs look fairly in range to what they should be, or if they're not, and you think you can add value by coming in and reducing food costs, then you should absolutely go ahead and buy the business, right? That's what I look at. Location matters, where you are, what kind of food you're selling, who's your demographic around, all of that stuff matters. So you look at that too. But I have no background in running a restaurant or having a food business. But I think, you need to be able to someone who can pick up things, take up a challenge and learn along the way. And you know what? Most people, when you have your money put on the line, you end up doing that. I'm a strong believer of you should put people, throw them in the water. They'll either learn to swim and stay afloat, or they drown. So things like, when push comes to shove, you'll figure out a way. That's my strong belief. Other businesses I've looked at are an online beauty products company. I've looked at a car
passion
rental business.
of you, right? Yeah.
Sorry?
That's a passion subject for you.
Yes, that's a very passionate subject. Online beauty products.
Beauty products, not the fact that it's online.
I feel very strongly about that. I'm kidding, obviously. No, it makes money, and that's what I like about it, right? Relatively low inventory, big margins. You don't single man operation. You don't need anyone. You get orders. You pack up stuff and you ship them. That's it. You get payments when the orders come in. People pay by credit card when you're placing an order, so there are no receivables. You have minimal inventory. There are no payables. You don't need a separate office space. You store it in your basement or your condo, wherever you live. The products are fairly small, so they can be stored anywhere. Great business model. Like, why wouldn't you look at that business? Makes really good money. I can't disclose the details of a lot of these businesses because they're confidential. But I'm more than happy to chat with anyone who wants to know more about these on a one-to-one basis. But again, a great business. Another business I've looked at is a car rental business, not like one of your enterprises or one of these bigger ones. This business only services insurance accidents. So when you have an accident, you're stranded in the middle of the highway or road or whatever. The towing company takes your car. They also take you to the nearest car rental place so you can go get a alternative while your car is being fixed.
Mm-hmm.
That's all he does. He gets a
Right.
He gets a rental car, like he has a fleet of cars. Someone comes in. Generally, when you're in an accident, your car is gone for anywhere between a few weeks to maybe a couple of months.
Mm-hmm.
So, you rent out a car to someone like that. You're not seeing your car back in your parking lot for a month, which is fantastic because you're making money for the entire month and you don't have to worry about maintaining that car. Compare this to a weekend renter. Someone who rents just on the weekends to your walk-in clients.
Yeah.
Your car goes out on a Friday, comes back on Monday morning. You have to wash it, you have to clean it, and you have to do that 4 times a week. Versus in this case, you only wash and maintain your car once a month because it's gone for the entire month.
That's good business. Right.
Great business, and you get payments directly from insurance companies, so you don't have a whole lot of receivables. And you turn over your car you have leases for these cars. These cars are not bought, they're leased. And you have a 2-year or 3-year lease. At the end of the 2 years or 3 years, these are fairly popular cars. So they have a value aftermarket as well. So if your buyback from the lease is lower than the market value, you buy it back and right away sell for the profit in the aftermarket non-dealer or the second sales market,
Mm-hmm.
And you make some money there too. So very interesting business again. So I've looked at a whole spectrum of businesses from car rental to manufacturing to food businesses.
Right.
What really, again, my strong feeling and my strong belief and thought is you don't need to be an expert in that industry. You need to be able to be someone who can learn things quickly in that industry, but you need to first make up your mind, is this something that I can handle? Is this something that I can tackle? Is this industry attractive to me? Is this industry attractive in general? What's the future of this? Once you answer those questions, then you go into the financials and look at how the business is performing, what the cash flows are, what do you value it at? How do you finance it? All those come after that.
How you add value.
Exactly.
And then just to go back, you're talking about food business. I know you were looking at a hamburger business. I hope I'm not disclosing too much.
No.
And you're passionate about hamburgers.
I am.
And then my concern is, because my concern is anything that you're passionate about. Say you are passionate about hamburgers. I like hamburgers, right?
Yeah.
My concern is if I spend too much time in it, I will no longer like hamburgers.
Then you should not buy that business, Urban.
That's the scary part. And now one concern I have for people who are getting into businesses, saying someone new acquiring a business is, and also you hear this a lot. I'm sure you hear this a ton from people selling their businesses. Is they think, oh, my business is worth a lot, and then you just simply look at how far does the business go when you're not working there, when the owner doesn't work in the business.
You mean how far does the business go when owners don't work in the business? Yeah. I.e., are they?
Can the business operate without the owner? And then
yes.
On the flip side, like when a buyer's buying a business, there's a potential you may be buying a job, which is like scary to me.
No, so there are certain businesses that can function without the owners being present, i.e., a passive investment business opportunity.
Right, because that's partly why real estate is so popular. Yes, it's largely passive.
It's hands off, right? You put your money in. If you're doing your reno, you be on top of the reno. But once that's done and it's rented out, it runs itself. You don't need to do a whole lot. Mm-hmm. And especially if you have a property manager, then you probably don't do anything at all except pay the bills or whatever, and collect rent. And that too comes in your bank account directly. But there are businesses. So one of the businesses that I'm working with right now with a client is fairly. The owners are not deeply involved in that. It's in the healthcare space. There are doctors that come visit that place. There's the front office admin staff who runs the the entire show for that clinic. They have about 2 or 3 of those clinics that they own. And these guys are not doctors. They are not healthcare professionals. But what they do is they stay on top of, how business is going, how the sales numbers are doing, how's the cost coming along. And you can do that staying at home. You get reports. So they are fairly hands off. And that could be a good opportunity for someone who's looking at passive investment opportunities. Another one that it's fairly popular in Canada, and probably the States as well, is gas stations. You have a convenience store with the gas station, you hire a manager, and you have the staff underneath. You don't need to go run the place. Of course, if you go run the place, you'll save the manager's salary that you're paying anywhere between 40 to 60K. So that's extra income to you. But even without that, they generally tend to have good returns on investment in terms of investment profile. Gas stations, again, fit that bill of passive investments. I've seen a lot of them do that, actually. Office buildings, it again goes to real estate, but sometimes in the commercial side, I don't know, not many people know this, but larger commercial spaces, they sometimes get creative with how they structure their rents. They have a base rent, and then they have a percentage of sales done from that location. So in some ways, you're investing in the business as well, because higher the turnover of the business that's renting your office building, higher your rent also gets. This is quite common especially with retail outlets and big shopping malls. They have a base rent and they have a percentage of revenue that, and generally, if you're doing well as a business, then the landlord also does well as a landlord because they get higher rent. So you could get into that. You could, there are a bunch of these passive investment opportunities that you could look at, but you still need to be on top of those things. It's not, I wouldn't say it's as hands off or as passive as a residential real estate can get. They would still need a little bit of monitoring, maybe on a monthly basis, or say a bi-weekly basis, but there's still a little bit of effort required there.
Yeah, I'll just say this one thing about, and we share this with our clients around like property management, for example, is, sometimes the client is the best property manager as possible, right? Sometimes. Right?
True.
But you can't be everywhere.
No. Case in point, I tried to be a property manager when I got my first one. I live in Toronto. My property was in St. Catharines. The first few months were fine, but then issues started coming in, and then I had to go down every time from Toronto to St. Catharines. And I also have, I had a day job back then. So try going from Toronto to St. Catharines at 5 in the evening. You probably won't reach 7. I did a few of those trips, and that was it.
Takes like 3 hours.
My time was worth a lot more than saving that 5 or 8% or 10%, whatever you pay every month to your property manager. And I think in general, they also, because they are professionals and they do this in and out, they're more well-versed with the laws and regulations and what to do and what not to do and safety hazards and whatnot. This one time, my tenant called me and said, the fire alarm is beeping, and when I open, it says carbon monoxide leak. What am I supposed to do? I'm like, I don't know. What am I supposed to do? So I went up, read, and then told them back what to do. And then the next day it started again, the same carbon monoxide went off. So, things like those, sometimes it's nothing, but sometimes it can end up being a big, big issue, especially if, there are health concerns or there are health impacts to your tenants. Right. You don't want to take that risk with people's lives. Right. So it's better to have a professional there.
Right. And just quick tip for anyone who has that situation. What I do is I'll tell my tenant to go, like, perfect world, you already have a brand new inbox carbon monoxide detector in the property, so you simply go tell them to go get it, plug it in, and see if that sets off the if the carbon monoxide sets off the if the alarm goes off. Well, actually, the first step is usually shut off the furnace, right? Just flip the switch, shut off the furnace, right? And then once you have the redundant carbon monoxide tester, plug it in, turn the furnace back on. You probably want to open windows. Maybe you want to stand outside while you're doing this test.
Yeah.
And then see if the second one goes off. If the second one goes off, you probably have a problem. And the point is, carbon monoxide detectors aren't that accurate. For example, there was a massive recall by Kiddy, not that KIDDI, not that just recently. So like millions of units had to be recalled, and yeah, they're designed to detect like almost like no unit. They're designed to detect like almost no units in the air. It's crazy how accurate they're supposed to be, and they're only like $30 each.
Wow.
So quick
Wow.
tip on that. So yeah, perfect world. Have a brand new inbox carbon monoxide detector in your property so that the tenant can go get it and open it up, so that you don't have to make that 3-hour drive to St. Catharines.
Sure. Absolutely. Thank you for that, Irwin.
Anytime. And what I was alluding to with the like the investor may be the best person to manage the property, maybe, right? And in some cases, in many cases, the business purchaser, the new owner, may be the best person to run the business. So people have to keep that in mind as well, because if you want to like drive like sales and implement new marketing and implement new like culture and things like that, those things are not easy to find talent for, right?
No,
And expensive.
Yeah, and expensive. And you know what? Nobody's gonna pound the payment like you would for your business, because
Right.
end of the day, whoever's in there gets their salary. Regardless of how your business does. You're the only one who's going to care if your sales are going down. Why are the sales going down? Are my customers getting the right service? If not, what do I need to do? You're the only one who's going to care about it. If you don't, you shouldn't get into a business, but you're the only one who's going to care about it and do something about it. In most cases, unlike in real estate, the owner is probably the best manager of the business, especially in the small to medium space. Once you get at the large corporate space, obviously you have a different management team. They're professionals. They run it for you. There are public companies that have shareholders, and the shareholders are the owners, and all that comes in at a very large scale. The small business owners, you are the best manager. You're the one who should be managing that. Only get into a business to not manage it as long as it fits that bill of being a passive investment. Otherwise, don't expect to buy a business and then give to someone else to run, because they will run it to the ground for you. Believe me about that.
Yeah, real estate sounds easier. The PM's not going to run your investment property into the ground.
No. It generally is an easier investment than investing in a business, no doubt about that. And that's
Right.
why, business is higher risk, but also higher return.
Right. And for anyone, and I'm not saying that people shouldn't be buying businesses. Like I run a business, you run a business, right? It can work. It's just understand, like Ajay and I, like we work our tails off to be good, right? And not just that we're motivated and pounding the pavement, but we're continuously investing in ourselves to develop our HR skills, our communication skills, our presentation skills, right? All those things. Like we're trying to do everything to make ourselves well-rounded. And anyone who wants to excel in business needs to do the same.
Absolutely. Business again entails a lot of hard work. Irvin knows that. He's been running his business, 10 plus years now?
Yeah, something like that.
Yeah, so it entails a lot of hard work, especially in the beginning. You don't have a life, and that's true. I've come to know, ever since I've been in this business, I've come to know of places I never even knew of in Ontario. Had you heard of Tillsonburg, Irvin?
Yeah, I've heard Tillsonburg.
You had?
I don't know where. That's the other funny thing though about knowing places in Ontario, because I was a hockey fan. I still am a hockey fan. I just don't have time for it.
Got it.
But hockey players are all from Canada, so this defenseman on our team is from Tillsonburg, Ontario, and that's how I know it. I couldn't find it on the map. I could not.
Yeah, anyone living in the GTA would probably, in general, not know Tillsonburg unless they met someone from there or they know of it from before. But I had to go there to go see a client's business, and we finally got the listings. It was a 1.5 2 hour drive, but you have to do it. And the client lived in Kitchener, so I had to first go to Kitchener to meet him, get to know details about the business, and then go to Tillsonburg to drive through that and get to know about the business, and then go back and forth. And so in my business you get to travel a lot, and travel as in not take flights but by road, and it can be crappy sometimes. And you know what, when someone wants to sell their business, they don't care if it's November or December or January. They don't care if it's minus 30 outside, if it's snowing. You still have to get there. What I'm trying to say is, it's not easy. There are these challenges with my business or with Irwin's business. There are Other businesses would have other challenges which will take up your time. You need to be prepared to put in that time and effort and energy to make it successful. And if you can get through that, and if you can get at a decent level, you will reap the benefits of it. Case in point, another client that we had, he bought a business, another car rental business. When he bought it, it was one car literally. Within a year and a half, he's made it into 15 cars, and he's selling it for pretty much like 7, 8 times of what he bought it within 1.5 years. So if you're willing to put in that kind of effort, you reap the benefits too.
Right. So I looked up Tilsonbury, I Googled it, and obviously, how do we not know? It's right next to Mount Elgin. It's just west of Otterville. Like, population. I'm really sorry for anyone from these places. We're just, it's 15,000 people. I had no idea where it was, and there's actually no major city near or close to it.
No, I think the nearest one is probably Woodstock. It's between Woodstock and London, but you have to go south further.
I want to see how many people can find Woodstock on a map. Because people like when you hear Woodstock, you think of the concert, but that's not where they had the concert.
No. Yeah, I've been to Woodstock as well for another business that I was looking at. So it is a lot of hard work having your own business. One other thing that comes, I don't know why it is so. It shouldn't be this way, but generally with businesses, it becomes a lot harder to get a mortgage from a Schedule 1 bank. They like people with a steady job and a salary coming in. They hardly ever like people with a business background who are business owners. You could be making $500,000 a year, and you would still probably most likely get a more expensive mortgage than the person who's making 100,000 but working for a large company. Everyone, correct me if I'm wrong in that.
Well, it's just more rules, and the first one that most people are familiar about with being self-employed is the lender will qualify you based on your average last 2 years, your income for the last 2 years. And then one of the realities of being self-employed is we have the benefit of many things we can deduct from our income, like our cell phones, home office expenses, our vehicles, our gas, our leases, right? So then all these things, a regular person with a T4 and a job has to pay all these things too, but that doesn't come off of their income versus it does for self-employed. So then you look like you make less money, even though really your take home is the same as the other guy.
Probably. Yeah.
But yeah, that's just the reality. But again, I don't want to discourage people from getting in. No, actually, no. Yeah, I still don't want to discourage people from investing in businesses because, I just know so many people who've lost their jobs recently, right? Is it crazy? And to hear the person who has a job, like, 'cause you lost your job recently.
Yes.
For people who rely on a single income, like you think me having several properties is risky? Like, okay, and it's just a completely different mindset. What they consider risky versus I consider risky.
Right.
Like, go read When Corporations Read the World. Okay, no, actually, no. Better yet, put yourself as a shareholder's point of view. Right? Shareholders own the company. What do they want? It's all about the bottom line. It's not about making sure you have a job or you have job security.
No.
Right? They don't want you to have a pension.
No.
They will take away your pension as soon as they can.
Absolutely. Bottom line, everyone cares about the same thing. What is my money going to make, right? Mm-hmm. And sometimes that can have conflicting sort of end results. Mm-hmm. As a shareholder, for your money, you want the best bang for the buck. Yeah. But then as an employee, that may not necessarily translate into the same thing that a shareholder wants, because shareholders obviously want lower expenses, so profits go up. But then you also want fair wages for your work and your time and your effort, right? So that's conflicting interests right there. So a whole bunch of these things. End of the day, the story is you want the best bet, the best buck for your money, the best return for your money. Right. How do you do that? Real estate is a great way. I found investing in the right business is also a great way of doing that.
Mm-hmm. I think part of the decision making is, for example, like if you can score 50 goals in the NHL, go get a single income job. Go scoring 50 goals a year in the NHL, right? If you can do that, that's smart. That's
Yeah.
I don't think that's really risky, right? But if you're talented and you feel like you're getting paid less than what you'd be worth on the open market, especially if you're running your own business, then why wouldn't you?
Yeah.
Right? Why are you making money
Absolutely.
for somebody else? Why don't you make it for yourself?
Absolutely.
Right?
Absolutely agree on that. Agreed. Those, that is essentially true. But then what you also have to think is, not everyone can, and again, it varies from different life stages, right? That sometimes you want to do a business, you want to do a lot of things on your own, but you may not be at the right life stage or career stage to take the plunge. Like I knew I wanted to do a business ever since high school. But I also knew that working for someone else will teach me a lot of things, and that will help me later on in doing my own business. So I went out getting a corporate job, getting all the education I wanted to get, and learn things, on someone else's dime,
Yep.
in
Yep.
essence, and then use that for yourself. So you need to figure out that right time, right place in your life to be able to do that and take the plunge.
Right. Right. And then, sorry, I was reading Think and Grow Rich this morning, so it so much come down to how determined are you,
Yes.
right?
Absolutely.
Right.
Determination, dedication, grit, very, very important. I saw this recent thing on, it reminds me from grit. There's this article, or there's this podcast going in on LinkedIn, where there was a US psychologist or researcher who had done research on kids in a particular age group, and what set aside kids from being more successful than others, from some kids being more successful than others, was not their IQ or intelligence, but really the grit factor. How determined are you to go get what you want? That's what determines, based on that research, how successful you can be in life. So
Right.
don't underestimate that grit factor. If you don't have the highest IQ, doesn't matter. Not to say people who have high IQ don't go far. Obviously, they have that added advantage and the benefit of being ahead of the curve already. But grit plays a big role.
Right.
You can catch up just based on your sheer grit and determination.
Yeah, people like Elon Musk, I think, is a good example of grit
Yeah.
and IQ.
Yeah.
Right.
Yeah.
Versus, not versus. I think real estate, even if you have a low IQ, you can do very well. Right. If you have a high IQ, you can start building some crazy stuff.
Another example for the latter part is the most recent U.S. president.
I don't know. I think he's just sharking us all. I think he's just playing dumb.
No, look at it. Well, could be, but listen, I don't think. Again, this is my personal views. Don't judge me for this, but I don't think he's one of those high IQ, super intelligent guys. But business, regardless of what kind of person he is, business wise, he's done well for himself.
Yeah.
That fact you cannot ignore, right?
Yeah.
And even through his however he runs his current office, there's one thing in him that you will definitely notice. He's got determination. I remember
he'll never give up.
No, I remember the time when Obama was the president, and there was this White House dinner reception for journalists, and Donald Trump was there, and Obama was making fun of Donald Trump wanting to be the next president, because by then he had already made his plans clear and public that he wanted to be the next president, and Obama was making fun, and the entire room was laughing. And fast forward a few years, he is the president today. Despite that, he's gotten here. Now, what kind of a president he is, that's a different question, and we're not getting into that. But to achieve what he wanted to, he had the determination to do it despite all odds, and he did it.
And I'm pretty confident he works a lot of hours.
I'm sure he does. Yeah. I'm pretty sure he does. How productive they are, I don't know, but I'm sure he does.
And he golfs all the time. But based on how much I think he does puts in a lot of hours.
Yeah.
And he's a get up early kind of guy, and I think he's working late, because we know he's working late because he's tweeting late. Okay, so Ajay, we're running out of time. So I want to ask you, have you seen Cooking of Books?
No, I haven't actually.
No kidding. Wow.
No,
really?
I haven't even heard of that until now.
No kidding, eh?
Really?
How come that happens in the public markets, but it doesn't happen here? Like, you think, wow, really? You
No.
think in small business it'd be much easier to get away with, just like crappy accountant signs off on your
Sorry, you
statements.
mean actually happening in small businesses?
Yeah. Like
Oh
just
yeah,
like
yeah,
say a small business wants to sell,
oh yeah,
they
all the
tweak some
time. Like
numbers.
it's so much
Okay.
harder to evaluate small businesses
Yeah. Oh,
because
especially cash ones, cash
it's
businesses.
especially cash ones because these are like these guys don't put everything on their books. That's the
Hmm.
problem. A lot of these businesses that I've looked at have a cash component that never goes into their books. It never goes into their bank account. But the guy's making money. You can see it. Like you can see it from the car he drives. You can see it from his lifestyle. You can see it from the business he owns. You can see it from where he lives. And then, there are ways to even figure that out. Let's assume, on average, someone who runs a small business and lives in a particular location. I'm going to make up things here. Has, let's say, $40,000 or $50,000 in annual expenses. Now, if you go back and look, is he drawing anything from the business? If he's not, he's got to pay those expenses somehow, his personal expenses to live, right? The fuel for the car, his cell phone bills, his groceries, his house mortgage, whatever. That's where you know that there's some cash component which he takes all cash and then he pays his expenses, or he lives off the cash and doesn't take a whole lot out of his business in terms of a salary or dividend or what have you. So there's one way of looking at it. The other way, generally, I generally tend not to put a value on the cash component of the business, i.e., if you're not showing your sales on your books and you're saying I make 100,000 in cash above the 300 I'm making on my books, then whatever multiple I'm paying them on 300,000, I generally tend not to pay that same multiple. I tend to, negotiate a lower multiple for that cash component. And
Hmm.
even that is paid only 6 months or a year out after I've seen that kind of cash as while running the business after we've closed the transaction.
Right.
Otherwise, I generally just, if they disagree with that, I walk away from the transaction. I don't
Right.
want to pay for something that is not verifiable. It
Right.
may well be there, but I cannot verify it. So the other way is, once we close, let me run for a year, and if I see the same kind of cash, then you get your money as well.
Right. It sounds like very complicated transacting on businesses, not that dissimilar from transacting on investment property.
No, it is a little bit more complicated. You have to look at a number of things. You have to look at other than just the revenue and the cost and the profit.
Yeah.
You have to look at working capital. How much money do I need every month in my bank account to run the business? What does that constitute?
Yeah.
I have to pay my rent for the office building or for the factory. I have to pay my wages for the
Mhm.
people who work for me. I have receivables. People don't pay me when I sell to them. They don't pay me right away. They pay me in 30 days or 60 days.
Mhm.
I have to hold inventory, so I need money, certain amount of money to run the business every month.
Right.
And you need to factor that over and above what you're paying for the business or cash flows, right?
Right.
You have to look at the land lease. Sometimes, it sometimes the business may be running at a place that the owner owns the real estate as well, but in a separate corporation. So he's doing whatever he wants there, but the business that he's running there, it may not be zoned for that. So you have to be careful of those things as well, right? It's my land, so I'm running my business here. No one's questioning me about
Right.
that, but it may not be the right zoning. It may still be a commercial zoning, but it may not allow for that specific business to be run over there. I haven't come across any of that, but those are things that you could come across in evaluating a business.
Right.
For the car rental business, a good question would be: so where do you wash your cars? Where do you clean them? And are you authorized to do that on the land because there's land contamination, right? What does that do? Will my landlord let me do it if I'm running a car rental business in that place and washing my cars in the same place? Does my lease let me do that? So, there are those complications. So each business has its own complication.
Yeah.
In a franchise business, for example, you need to be approved by the franchisor. Let's say you and I, as a buyer and seller, agree on a price, we have an agreement. The deal can still fall through if the franchisor does not approve the new buyer.
Right.
So that's another complication. The buyer's agent needs to have a condition in the offer saying this is conditional upon the franchisor approving. If the franchisor does not approve me, then the deal's gone. It won't close. So there are those things that you need to be careful about in each business, and a business broker should be able to tell you that. If your broker's not telling you that, then don't hire them.
Very cool. All right, Ajay, we're out of time. How can people follow up with you if they want to connect with you, buy a business, sell a business?
Happy to give my email, Urban, and you can put it in the email that you send out. They can connect with me by email, and I'm usually good at responding back. And then we can take it from there.
Okay, very cool. And for folks who want to see the contact, Ajay's contact information, I'll share it in the show notes at truthaboutrrealestateinvesting.ca.com. One of those.
Thank you so much, Urban. Thank you for having me on your podcast.
Ajay, thank you, because like I said, owning a business is a pillar of getting ahead in life. So I don't know what it is, but like so many people graduate school and they think I need to get a job, right?
I agree. Not a whole lot of them, have the courage to go on their own, but the ones do come out, further out in life than the others. And even, hey, not necessarily that every business that you buy or the first business that you buy will be a blockbuster. You also learn from your failures. A lot of the clients I've dealt with have had multiple businesses over their lifetime, and not every single one of them has been successful. And they've still had the courage to start the next one or buy the next one and make it a success because they've learned something from their previous failures. So that's the important part.
Right. Ajay, thank you again. And that is truthaboutrrealestateinvesting.ca.
Thank you, Irvin. And
Thanks again. Have a great weekend.
Thanks, you too. Bye.